And welcome back to another episode of the Brutally Honest Loan Officers podcast. I'm Derek Brown. With me, as always, Stephen Brock.
What's going on?
How you doing, buddy? Did
Good.
you have a nice little Halloween and uh time change weekend?
Halloween was good. Out for a couple hours. And I think I definitely had more adult drinks than candy being passed out. Because I feel like our neighborhood, like you better get here early and you better that until about probably 9, 10 o'clock at night. You're not, because it's a weekday, you're not driving through the neighborhood at all.
Heard.
There's so many people and people come from other neighborhoods to ours. But yeah, it was good. What about yours?
It was great. We actually went to a friend's neighborhood. We had a lot of fun hanging out with them. Kids had a blast. And then we left at like a normal time, but we had to slow roll through the neighborhood for that
Yeah.
exact reason you just talked about. But no, it was fun. And then we had the time change and it punched me in the face. As I hate it. I hate it. Bennett's 2, Audrey's 5. They don't understand. So they just wake up at their normal time. Even trying to keep them up at night so they sleep in a little bit. No, no,
That doesn't work.
no. So this morning everybody was up super early. I mean, we made it to work on time. That's a good thing. So, but no, I mean, it's a good weekend. Now back to work. Uh, Election is tomorrow. Oof.
Woo!
Who's going to
Finally.
be our new president? I don't know.
I don't
It's
even know
back
if
and
we'll
forth on who's leading the polls.
I don't even know if we'll know tomorrow. It might be a couple of
No, I
days.
think we're going to be going to bed. Yeah, okay. Some people will most likely stay up until it's announced.
Yeah.
I will be going to bed and I'll wake up Wednesday to find out who my new president is.
You know what
But
it doesn't change?
what you and I do on a daily basis,
Exactly. Nothing
you
really
know,
changes. You create your own opportunity.
yep. So I don't know. There might be some myths around how it affects you, this election and stuff. Speaking of myths, let's get into it. That's our topic today. Mortgage myths. We're going to debunk some. So, Steven,
Yeah.
what you got?
First one, you need 20% for a down payment, right? That is what everybody thinks.
That's
That is
what the boomers did.
that is what what's his name? Dave Ramsey says you need to do, which is not true at all. While the 20% down helps, avoid having the PMI, the private mortgage insurance on there. It's definitely just not a requirement. What do you think? What do you think what most I'll say most first-time home buyers think they might need 20% down.
I mean, I just think that that was something that was said back in the day. Like, you should buy a home once you have 20% down. Hear me out. You don't have to. Now, if by all means, if you could pay for a house in cash, do it. I'm a supporter of that. If you have the cash, if you have the
Yep.
means to do so, yeah, do that. My goal is to pay off my mortgage. But do you have to put 20% down in order to purchase a home? You do not. There's a lot of programs out there that can help you purchase a home with as little as 3.5% down. You've got VA and USDA that are 0% down. There's first-time home buyer programs with down payment assistance that can help you bridge that gap. Stephen and I have said for years, trying to time the market is not as important as time in the market. So I think that somebody that's trying to save up that 20% and has to wait another 2 years to do so, I think they're missing out on a lot of equity that they could have built. So do you have to put 20% down? No. If you've got 40% saved, then we might find a happy medium of how much you should put down
Yeah.
and keep some saved, keep some invested, keep that emergency fund. Um,
You
but
need
you
to
do
look
not
at what is the
need.
minimum you need to be. I tell people all the time, find the minimum number you want to put down that coincides with the budget and monthly payment you want.
Correct. Correct.
If you can meet those things, then great. If you put more down, that's fine. But people don't realize putting more down, yes, it's being put into the equity of the home and you have it there, but it's not liquid. So if you don't
Right.
have the emergency fund or investments going and stuff like that, you can't tap into it easily.
Yeah.
So that's the other aspect of looking at it. Some people are like, oh, well, I got 20% down, but then I have nothing else after that.
Well, right. And like I've had countless buyers come to me submitting all their statements and stuff like that. Okay, you've got 35,000 between checking and savings. Like, how much are you wanting your total cash to close to be? Well, Dan, I mean, we've got 35, so 35? No, no, you should probably not do that.
Yeah.
You got to save some. You're about to become a homeowner. Everything's on you. It's not like you're going to be calling the landlord to come and fix your AC. It's going to be on you. You need that, the reserves, emergency fund, all that stuff. And I simply just want the cushion for somebody to feel comfortable. So you
Yep.
do not need 20% down to purchase a home.
All right. What's the next one?
All right. Another common myth is regarding student loans. If you have student loans, you can't purchase a home. Well, Stephen,
You can. I don't
you
know.
most certainly can. Yeah. Just
You
because you have
definitely
student
can.
loans, if anybody says no, you can't buy a house while you have student loans, that is inaccurate. Um, I and I'm not sure where that stigma came from. Maybe it was back in the day, you need to pay off all your debt. You can't buy a home with debt. I don't know. But no. Is it going to factor in what you might be able to get approved for? Sure.
We
There's
factor
a
in
lot of
like
student loans that are
anything
still in
else.
deferment. What was that?
So we factor it in like any other debt that's on your credit report. If
Yeah.
it shows that you have a monthly payment on there, that's what we're going to go off of. Now, you were just saying deferment. Deferment's different, so I'll let you keep going on that.
Yeah. I mean, a lot of student loans have actually been not coming due, but payments have been adjusted,
Reinstated.
um,
Yeah.
reinstated. Thank you. Um, so for anybody that might be listening, if you have a student loan and you haven't like looked into it recently, there's a pretty good chance that there's a payment due. So I would go and check that as quickly as possible. But that payment is what we factor into your debt to income ratio. Just like if you own a car and you have a $250 payment, we factor that into your debt to income ratio. If it is deferred, sometimes we can go off of zero, depending on how long it's been deferred for, how long it's deferred to. We might be able to go by the deferment, zero payment. If you're an income driven repayment plan, we need all that paperwork. Sometimes we can go off of that. But I do like to still factor in a payment. Like, you are going to have to pay this back eventually. So we're not trying to overspend on the house and then prevent you from being able to pay your student loans back later.
Yeah. All right.
Okay.
Next
Myth,
one would
myth number
be
three.
you need a perfect credit score to get approved. Hear it all the time. Hey, I need to work on my credit. I need to work on my credit. Most people don't want a hard credit pull, so we'll do a soft credit pull on them. And I'm like, your credit's fine where you're at. Like, can you improve it? Yes. Will the improvements help your interest rate? Maybe. Sometimes they don't, because you're not improving it dramatically unless you have a really low credit score and getting it up. But it's amazing to see that people will even stop from trying to look at it, they can be approved. Like, they're not even asking the question, like, hey, can I get pre-approved? Because they think their credit's horrible. So
Right.
what kind of credit scores do we actually work with, Derek?
I only work with the best credit scores. So no, no, no. I get the same thing every single time with somebody saying that they're working on the credit. Well, what does that mean? There's people that are trying to get above 700. Well, we have every single loan we do. Well, I take that back. There are certain non-QM loans that require
Yeah.
700 or higher, but most of the loans that we do for first-time home buyers, conventional FHA, VA, USDA, we can do with scores in the 600s. Now, like Steven said, can it impact your interest rate? Can it impact several other factors? Yes. Do we want you to have a higher credit score? Well, sure. It's most likely going to give you a better interest rate. But FHA loans, we can go as low as 580. There's other lenders out there that say they can go down to 500. We're looking at the ability to repay, and your credit score is a reflection of your credit report that shows you, paying things on time or not. If you have a lower credit score, you most likely have missing payments. Something's gone past due. You might have collections. But remember, credit's a game. You just have to play the game. You got to
Yep.
borrow a little bit, and you've got to pay things back. You got
I
to pay
think I
them on
saw
time.
I saw a post recently that somebody is like, why to get a credit, why is a country that's so far in debt telling us you need a credit score to purchase anything? And I'm like, well, technically that's right. You have to have debt to get a credit score.
Right.
You have to put things on a card, mortgage, whatever, to actually get a credit score. There are plenty of people that are like, I pay everything cash, and it's like the last thing they did on their credit was 5, 6 years ago. And I'm like, there are loans that we can do with no credit scores. Not meaning
Sure.
you have it frozen or it's blocked, like you legitimately have no credit scores. And all that's doing is like it's like your resume. It's like, hey, I take these things out and I pay them on time. When you don't have that or you don't pay them back on time, like it's hard to lend to you. Or what does that mean? It's more of a risk. And how you're saying, Derek, like the different adjustments, it's the loan level pricing adjustment. So think it's is it every 20? Every 20 points kind of on a credit score, you start seeing a
Right.
change, at
Yeah.
those thresholds, and every 5% down puts you in a different bracket of where that risk factor is. So that's
Well,
what,
I mean, think of it this way. When I said like your credit report is a reflection of your, ability to repay something.
yeah,
If I was going to lend my own personal money, or for, anyone listening, somebody wants to borrow money from you and they don't have any proof that they can pay something back, you're going to question whether or not you should lend them the money.
yeah,
Now, when we do this no credit score loan program, yes, we have options, but you've also got to show your ability to repay. So now you're providing paperwork. You have to show a lease agreement, a rent schedule, that you've paid your rent on time. You've got to go and get a cell phone bill, show that you've paid it on time. You've got to go and get um, what is it? Cell phone bill, utilities, like so your electric
yeah.
bill, water bill, something like that. Show that you pay on time. You have to still, again, show us that you pay things on time. Now, if you just had a credit card and car loan or whatever, and you paid it on time, we simply pull your credit and we can see that. So it's honestly just easier if you take out some small debts, have some small credit cards, pay them on time. So
Yeah.
you don't need perfect credit to get approved, but it is helpful if you do.
And there's things that we can definitely do. And I don't want anybody that doesn't, if credit is what's stopping you, I tell you to do a pre-approval, get a soft credit pull. Let's review it because we know plenty of people and plenty of things to do to help you actually improve. We have a system on our credit pulling system, report system that'll tell us like, hey, if they do these things or that thing, it will help jump their score up to here, and this is the time frame it's looking like.
Right.
And if it's too much for that system, then there's a couple of credit, I don't want to say credit repair, but there's credit building companies that we can refer you to help you build your credit the right way. Why I say steer away from the credit repair stuff, because sometimes they'll get stuff removed, but then it's proven that it was you that did wrong or missed a late payment, that they will put it back on there. And it could be a year or 2 years from now that they can actually put it back on your credit report if they prove that it was correct.
Yeah, like
Um,
those credit repair companies that talk about a monthly fee and stuff like that. And all they're going to do is we're going to dispute things on your behalf. Stay away from those.
mhm.
Stay away from those companies. Right. Back in the day, when everything was like you had to have paper trail of stuff like that. If you disputed something and they couldn't produce the paper, then they would just, okay, fine, we'll remove it. Now, everything's stored in the cloud. A lot of things are documented. It's way easier to prove that something was yours. So disputing it is just a waste of time and money.
Yeah.
So there's a lot of companies out there that are scams as far as credit repair goes, and there's some really good companies that know the system, know how to, help you improve your scores. So before you agree to sign up with this person that you found on Facebook, I don't know, check with your lender. All right. Myth number 4, pre-qualification and pre-approval are the same.
Right?
Well, pre-qualification and pre-approval are often confused, but they are not the same. Okay. A pre-qualification is basically where you've had a nice conversation with a loan officer, and based on that conversation, they've given you a pre-qualification letter, which means should they provide all their documentation, we should be able to do the loan. But a pre-approval usually lists everything that we have reviewed and says that you are pre-approved to purchase a home within these parameters and that we've verified your credit, your income, your assets. So it'll be pending title and appraisal.
So
So it's
basically, a prequal means
not shit.
yeah, basically, it's not worth what it's written on. I have told you that I make this much money, my credit's roughly this, and this is how much I have saved. Great. Off of that, you should be able to get approved, but I have no clue if you lied or not. And I don't even mean lie like you meant to lie. Like, hey, I think my credit score is this. Well, hey, my student loan payment kicked in and I didn't know, and now I'm 60 days late on it. Like, yeah, my credit score is definitely way down now. Stuff happens. Uh, so a pre-approval, like you said, we are reviewing it all. And I would say you have to be almost you have to be, not almost, you have to be careful with the pre-approval letter because now lenders have gone like, oh, pre-qualification and pre-approval, two different things. So I'm just going to call my pre-qualification a pre-approval on this person, but it had not verified. So you have to look at those pre-approval letters and make sure that they have verified all that information. So especially the listing agents out there, just because you get a letter that says it's been pre-approved doesn't mean they've necessarily verified. Like ours is 2 pages. Here's your pre-approval letter. Here's your other letter that says that we have verified this, 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 and this. Everything has been verified and checked off.
Right. Agreed. Not
All
the same.
right. Next one, myth number 5. You should always choose a 30-year fixed rate mortgage. So most buyers think it's the only option or the only smart option out there. While it's very popular, it's not always the best one for everyone out there. Some
Right.
people want to do a 15-year, especially, I will say this, especially with people refinancing lately. They're like, hey, I want to start refinancing or look into it. People are like, oh, it's going to, the thing that stops a lot of people or they read about is, oh, I have to start that 30-year, yeah, I'm paying less, but I got to start the 30 years over again. And now I'm paying more interest over that time. And I'm like, you don't have to. You can pick
Right.
a different year option on there. Now, what does that mean? Sometimes the interest rates are a little higher, sometimes they're a little lower, but that will also change your payments. Instead of making 360 payments, if you're going down to a 15 year, you're making 180, which means your monthly payment will increase from what it would have been at the 30 years. So you have to think about it. You're having a shorter time on there.
Right. Um,
So that's the fixer. What was
I mean, so my issue is that during COVID, I had quite a few people reach out to me that were in a 15-year mortgage that wanted to refinance into a 30. Um, they were having trouble making that payment because their hours had been cut or they had been furloughed. So, I mean, we're talking about a global pandemic that was unexpected. However, we were not able to refinance them because they did not have stable income. Their hours had been cut, they had been furloughed. So even though they did qualify before for a higher mortgage payment, we could not refinance them to the 30. And that was hard for me to tell people.
yeah.
And then they were looking into forbearance on their mortgage. So how can I skip mortgage payments, which we don't love that. And it just, had they had a 30-year, they probably would have been able to make those payments and like scrape by, after through those few months that they were working less or not working. Um, so I don't know. There's also been times over the last year where like comparing 15-year and 30-year, there wasn't that big of a difference in interest rate.
Yeah.
And if there isn't a big difference in interest rate, I would never lock myself into paying it back to 15 years when I could just do a 30, same interest rate, and pay it like a 15. And then if I want to cut back, I can.
So
If hours, if
keep going. Sorry.
so, like if my hours get cut or something like that, I can fall back on the lower payment. But when things are good, I can always, make extra payments towards that principal.
Yeah.
Um,
So what is it
I
if you
have
make one principal payment extra a year? One principal and interest payment extra a year would knock 7 years off your
7 years
loan.
off the life of the loan.
So if you make one extra payment a year, your 30-year mortgage is really a 23-year mortgage.
Right.
Making 13 payments instead of 12 a year. You're automatically knocking it. It doesn't have to be the 13th payment. You can make it, hey, every month I'm paying $200 or $300, whatever it is, whatever that extra payment is divided by 12 and put it in there and say, hey, go to principal. So you can
Right.
really make a 30-year to 23. And then what you just said, Derek, is, well, this month is a little tight, or hey, it's a holiday, so I'm going to take that money and use it for the holidays. You don't have to make that additional payment. You just have to make your regular required mortgage payment.
Right. So I had a customer, and there's, it also depends on what you can afford. I mean, if you're making really good money in a 15-year mortgage, like the payment, taxes, insurance, everything comes out to be like 15% of your take home pay, then yeah, go for the 15. There's so much room there for you to save and invest and do other stuff while you're paying the 15-year. I have a customer right now. They bought a little over a year ago, 30-year mortgage, and they have just been paying a lot towards the principal, like almost $50,000 extra last year. And so looking at doing a refinance, it almost doesn't make sense because if they just continue doing that, they're going to pay it off in like 6 years, And so then I ran numbers as a 15-year. If they were to lower the interest rate, it'd be significantly lower than what their interest rate is now. They could pay it off the same way and they'd pay it off in about 3 years because a lot more of every single payment's going towards principal plus the extra that they're paying, and it'll save them like $40,000 in interest. At
Yeah.
that point, yeah, 15-year makes sense.
Yeah.
But again, it just comes down to several factors. I don't necessarily think you should do a 15-year if it's really going to break the bank on you and it's going to be stressful. Don't do that. But adjustable rate mortgages are another option. Sometimes that gives you um, a little bit lower interest rate. And depending on the adjustment term when that comes, it could be, a good scenario for you. If you know you're only going to be in this house for 5 years, and it's a 7-year arm, maybe we look at that. It
Yeah.
just
I
depends.
will tell, because we were talking about loan level pricing adjustment before. Remember these arms. So, let's say 5/1 arm, you're in it, it's fixed for 5 years, and then it'll adjust every year after that. Once a
Right.
year, it adjusts to whatever the current market is. The thing that they see on that currently is that if we're in a rising interest rate market, then they're like, hey, they're going to refinance as soon as they can to get out of this. If the rates are looking like they're going to come down, they're going to get out of it.
Right.
So what does the secondary market do? They raise up the interest rates on those so people won't get them
Right.
because they know to make money off of it, they need a higher interest rate because you're going to refinance quickly. So also think about that. That's how that pricing works on there. That hey, it's most likely they're going to refi before that 5 year mark or before whatever mark they have on, or they how much money they want to make on it. So that happens, the rate is higher, so they can make the money they want on it. So
Right.
all right, let's go
Okay.
to the next one.
Myth number 6, the lowest interest rate is always the best option. So while we're talking about rates, that's been a myth that I think most of consumers think is accurate. The lowest interest rate is always the best option. Sometimes the lowest interest rate comes with the highest cost.
Yep.
So it really just depends. You'll see sometimes we compare conventional loans with FHA loans. And depending on credit score, FHA might have a lower interest rate than conventional, but they've also got a fixed PMI payment, whereas conventional, that could be variable depending on your credit score, your DTI, loan to value, stuff like that. So it might be a little bit higher interest rate, but you're paying less in mortgage insurance that'll come off after a certain amount of time. So over the long run, you might actually save money with a slightly higher interest rate on a conventional loan than an FHA loan.
Yeah.
But there's also times where FHA loans just simply make sense because lower interest rates. So um, yeah, could you pay thousands of dollars for a lower interest rate by paying points? Yeah, yeah, you can.
Yeah.
And there's usually a break even point of where it makes sense.
Just so
Now,
you
if
know,
we,
people, points is just prepaid interest. That's all it is. You're just paying that interest that they're not going to make on it that they want to make. That's all that's happening.
right. Um, so it really just depends. I mean, you can try and do your best to time the market and pay points so that you don't have to refinance as soon as you think. Or you might want. So there's just, I don't know. It's not always the best option. It's not just clear, that a lower interest rate is better. Um, there's a lot of factors that go into it, and you need to do your research. You need to find out, like, and there are times where paying points makes sense,
Yeah.
and looking through our different investors that we have, we can look for coupons, and that might be where, let's just say 6.5, 6.5 is your par rate. And then you start going down and it kind of goes up in price. So lower interest rate, price goes up. But then all of a sudden, 6.125 is cheaper than what 6.25 is. There's a coupon there. That means the investor wants you to, lock in a rate there because they think you'll have that rate a lot longer.
Yeah.
And you will likely not refinance as soon as, most consumers want. So they're giving a coupon is what we call it.
Yeah. That's what people have got to realize, that the secondary market, these investors that are holding these loans and servicing them and collecting all the payments from it, have to make money off of it too. So they're loaning out this money. They're paying us to loan out this money that they could buy it. So when they are holding it, that they have a break even and a profit line that they're trying to reach on there.
Right.
So the likelihood of that's why you always see, like, when rates get close to a whole number, like saying they're close to 6 or close to 7, that you'll see like 5.99 or 6.99, because hey, people are in that threshold a little bit lower than the 6 is at 5.99. They're most likely to hold on to it a little bit longer.
Right.
But I love the point that you brought up, like how paying points and all that. I have seen plenty of loan estimates from competitors where it's like, oh, look, they're offering me a rate in the fives, and they're 6.5. You can look up what the average rate is in the market. Just Google it. It'll tell you, hey, 30-year average rate. You can see it. So if somebody's showing you a lot lower rate, most likely you are paying for it. I
Well,
had a
also the average rate does
Yeah,
not say whether or not it's including points. The
exactly.
average rate is just simply the rate that has been closed.
So
So
you
if
have
it's saying the average rate is 6.625, I can promise you that that average rate includes points.
Well, that's what I'm saying. That you
Look
look
the
at
average
that, you
free
look at
rate.
that, you see the 6.625, whatever it is, and they're offering you something in the fives. You're like, that's off, because that average rate is already taking points in the account. So if it's that low, something is up with that. I see it all the time with it, especially now. Now all these letters are coming out for people to refinance, and one I just had one recently where it showed her, I think it was going to be in the fours, and she was going to pay 20, I think it was a little over 20 grand of
Woo,
points to refinance it.
woo.
And she was like, why would they even send this out? And I'm like, it's in the fine print. I was like, well, one, you didn't see it because she emailed it to
Yeah.
me and was like, is this a real thing? Like, can you match it? Because I want to do this. And I'd rather do it with you. And I'm like, I mean, I could probably match it, but it's not worth you doing, because how
No.
much money you're going to have to spend. You're not actually saving it. You're just moving it to a different, robbing Peter to pay Paul kind of thing. So yeah, you got to be very careful at that. Looking at the points, and even if don't just not just points, look at all the fees that they're charging on there. Because I've
Right.
seen some where they fluff up other numbers, so your cash to close is a certain amount, and then when it comes to the end, they change things, and okay, now you're paying points, but the other numbers are lower that they fluffed up, and your cash to close is the same, so you don't really look at it. But it's like, no,
Right.
you're actually paying, a price for that. So, I mean, Derek and I run our business on the numbers we give you up front will be the numbers that you're having at the closing table. Like, there is no switching them around with it.
Right.
All right, let's go to the next one. Should you wait until the market is perfect? Like we
Ha!
were we were already talking about. We hear this all the time. And I want to read. I posted this the other day, and I was really proud of myself for writing it. But let me pull up the post on there. I was like, all right,
Steven's coming to glow.
yeah, I have to. So it said, those with the excuse of waiting for the election to pass before buying a home. So next Wednesday, so still next Wednesday, they'll be waiting for the new year, and then waiting for Arbor Day. And then by spring, they'll be waiting for Ford Truck Month.
Yeah.
There's always a quote unquote perfect time around the corner. You can never make up missed market time. So
Yeah.
timing
Well,
in the
what's
market.
the other saying? Best time to buy a house is 5 years ago.
Yeah, yeah, that's always it.
Yeah.
It's
So,
like the tree. What's the best time to plant a tree 20 years ago? What's the second best today?
well, and I'll be honest too, like I was talking to a customer the other day, and they have a super, super low rental agreement. Um, and basically they've known the landlord. Landlord's not trying to make money. I guess the house is like free and clear, so they're renting it like well below market. And so they've been able to like invest and do some other stuff. They're like, Derek, everybody says we should buy a house. I don't know. I don't know if they should. I
Yeah.
don't get me wrong. Like, I'm a big believer in um, building equity and paying yourself instead of paying rent, stuff like that. But their rent super cheap, and they've been doing all the other right things. They budget. They've been investing. They've got college plans for their kids. I just so for them, you can take advantage of that super low rent because it's allowing you to put your money elsewhere. So, I mean, in certain circumstances, you know, is there a perfect time to buy for them? Well, I mean, they can buy if they wanted to, and so they're kind of looking to see if the right home comes and what that payment would be, but it's really hard to look away from what they're paying in rent. And I don't disagree with them
Yeah.
because they're able to, save for retirement and do all the other investments and stuff like that. So they're creating that nest egg over there, and it doesn't always have to be in home equity. It's just usually one of the easiest way for people to save.
Yeah.
So perfect time to buy. There never is a perfect time to buy. You've got to focus on like your personal finances, your personal, like just your job stability, what your short-term and long-term goals are. Like there's so many different factors that, go into whether or not you should buy a house and when the right time is. Um, I would hope that most people try to purchase a home sooner rather than later because it usually uh makes them create a budget and makes them think about saving. When I think about like my early 20s and when I was in college, I was not ready to buy a house. I wish I had. Oh
Yeah.
my goodness. Like I could have bought something right after the whole crash. Probably could have bought like a nice house for 60 grand, but I was an idiot back then. And I didn't like I knew what a checking account and a savings account was. That was about it. So I just had somebody had that conversation with me sooner, I probably would have thought about it and prepared myself a little bit better.
Yeah.
So like I said, perfect time to buy is always 5 years ago. So
Think
all
so.
right.
Definitely. Excellent.
Next myth. You don't need an agent when buying new construction. Okay, so there's a lot of consumers out there. Some buyers think that buying directly from a builder means they don't need an agent. And sometimes they walk into the model home and there's a sales rep there. That sales rep is going to work for them. No, that sales rep works for the builder, not you. So I would say that you always need an agent when buying new construction.
Yeah. Having your own agent just is someone's looking out for your interest. Even the same thing. Oh, I'm going to go directly to the quote, we said builder, but even just the seller, like trying to get to the selling agent and not have my own representation. You should find the realtor that best suits you and has your needs as a front of everything and use them to help you negotiate items, to help you understand the contracts because again, builder contracts are definitely different than every builder has a different contract. It's not just a state form. Here it is. This is their contracts. This is what they help, pay through. And I also want you to be able to look over past a lot of builders will give you all these bells and whistles of like, oh, we're giving, a $20,000 credit for this. Well, no, they're giving you a $20,000 credit to let you go from basic cabinets to the higher end cabinets that they probably
Yeah,
already have on stock. So they really
yeah.
not they're
They
not
didn't
losing
save you
money.
money. They
Yeah,
enabled you to spend more.
that's all it is. So you definitely need a representative for you to help you out with that. Yeah.
Yeah. All right. Next myth.
Once you're pre-approved, you are good to go. No. Not at all. It's not quite true. We definitely, if we were going to close the day we pre-approved you and we already have the house in mind, yeah, probably. Can't happen that way. So there are things that can change. So we tell people all the time, don't go buy new furniture, don't go buy, get a new car, switch jobs, tell them that you're quitting, retiring, any of those things, because it will change your credit score if you get all those new things. It will change your job status of what your income could be that we could count. I mean, you could go to the same industry but switch jobs, especially people that were like, oh, I was salary at this one and now I'm going to go over this and I'm part salary and part commission. Well, guess what? We're not counting any of that commission. So it could completely change what is going on. So until you close, you are not technically good to go yet.
Yeah. And that's where like, and I love my clients, like we send out like a big stop sign that says, stop, read this. Make sure you're not doing like large transfers, opening up new credit, and any large purchases that you're considering, please reach out to me. And there's times where, they'll call me and say, like, Derek, if we need a washer and dryer, so we're gonna put it on credit and we're gonna open up a new credit card with Home Depot because they're offering these incentives. Please don't. Please don't do that yet. You are not good to go there. Okay.
Yeah.
Now after we close, you might be able to do that. Especially if they're offering 0%, whatever, just make sure you pay it off before that switches over to 30%. But opening up a new line of credit before closing will make us have to get all the paperwork for it. A lot of those credit card companies, because there isn't a statement yet, it can be very difficult to prove what the new debt is and how much that payment is and stuff like that. So just because we say you're pre-approved, make sure you're listening to what we tell you. Um, don't quit your job. Don't take on that new job opportunity. Now, there are times where I've talked to somebody and they're like, "Derek, this new job opportunity, let's talk about
Yeah.
it." Okay. Like salary position, same thing you're doing, just at a different company. I think we're fine. Yeah,
Yeah.
go for it.
I had plenty of people change jobs in the middle of it, but we were discussing it beforehand and going
Right.
over like, hey, this is what's happening.
Yeah. So just don't make those big financial moves until after closing day. And the last myth we have for today, you should spend your full pre-approval amount. Nah, well, I don't know. I guess it depends on who's sending the pre-approval letter.
Yeah.
I tend to not maximize somebody's pre-approval amount on their pre-approval letter or the number, that we're discussing. So there's a lot of times where somebody could potentially maybe go up to $400,000 purchase price. But I'll talk to them. Where are you happy with like a mortgage payment, total cash or close? What does that mean? And so we land somewhere maybe 320. That's your pre-approved amount. Now, a lot of it really depends on property too. If we're looking at single family homes and we find a home that's a little bit newer, and has um newer roof, newer AC, stuff like that, where we know insurance is going to be a little bit cheaper, that could, help lower that payment, even though that purchase price might be a little bit higher. We can consider that, but I don't love anybody going their max pre-approval amount.
Yeah. And I will also tell you be careful on we we lenders in general can finagle that number in a way where I have seen people's pre like, oh, you approved me for 400, this person approved me for 450. I'm like, oh, interest rate's the same. And then I see the breakdown. I'm like, they said your taxes are going to be $50 a month. Not
Yeah.
happening. Oh,
No,
they
there's
said your insurance
nowhere,
is $25 a
has,
month. Yeah,
yeah,
that's not so
stupid.
you have to look at the actual what number they were used. So your pre-approved is not a total amount. It is what you can afford monthly and what your pre-approval amount monthly can be different from your budget. Like you were saying, let's just say you want to stay around 2,500. Well, your actual pre-approval amount is 3,000 a month. So you can make it look that 3,000 look at 400, 450, even 500 if you really try to stretch it out there. Like you could make those changes in that to show a different amount on those letters because I could show no HOA, no insurance, no taxes, and hey, yeah, you're pre-approved for 500. You're just not paying for anything else would can't happen. So you
Right.
got to be careful on that part too. You definitely want to look at what your monthly budget is on there.
Correct. Correct.
So that was the 10 myths that we had, debunking them, going through them. Hope that clears up some of the confusion and helps anybody listening move forward with confidence on there. So
Yeah. If there's other myths that you've heard, or you have any questions about what we mentioned, we'd love to talk to you about it. So we're just trying to shed some light on, the mortgage process and help other consumers understand what might be a myth or fact. So appreciate you joining us. This has been another episode of the Brutally Honest Loan Officers Podcast. See you next week.
see you guys.